And we can see in year 10, and this is on a 50-year-old client, and it's important to keep the age in mind because of the underwriting, we've got $129,044 in cash, plus the long-term care benefit. In this case, the long-term care benefit is $4,166.67 a month. That's the maximum amount. The total amount available is $200,000. So if the client doesn't use the $4,166 per month, if they use less than that, they would be able to use the long-term care benefit for a longer period of time than originally anticipated. So essentially $200,000 is available up to $4,166 a month in this particular case. But again, let's take a look because I want to show the difference between a 50-year-old and a 70-year-old when it comes to the long-term care costs. Again, in this example, year 10, there's $129,044 of available benefits. Let's go take a look at a 70-year-old. So this is on a 70-year-old person. Year 10, $115,168. So significantly less account value, same 10-year period, but because this is underwritten based upon age and health, the long-term care charges are much higher when it comes to the older person. And we'll show you a product that doesn't actually that doesn't apply to, which is the annuity care product by State Life. So we're moving on to annuity care with State Life. This is going to be still an annuity, but a different type of a product, different types of features and different ways of calculating the long-term care benefit. Issue ages 50 to 85, premium 10,000 to 500,000, and it's not available in a few states, Connecticut, Montana, New Hampshire, and New York. This policy is very different from the Genworth. There is a long-term care benefit, just like in the Genworth policy, but the way that it's calculated is very different. The rate that I'm showing here is a 2% rate on the account value side and a 3% rate on the long-term care side. And I'll explain what that means. I do want to point out that for the next 3 days, the actual rates for this policy are higher. State Life announced a rate decrease as of October 1st. The current rate today is a guaranteed 3% for the life of the contract on the cash side and 3.55% on long-term care if the cash is collected and the application submitted by September 31st. So for this purpose, I'm showing the lower rates because it might not be practical to actually get the sale done within a 2-day period. So the long-term care fund is growing at a 3% rate. The benefit is paid out over a 36-month period. I'm going to show you an example on how this all ties up. But basically, whenever you start taking out money for long-term care, they take 2.9% of that long-term care value, and that's the maximum amount that they'll pay out over a 36-month period. Again, if you don't use the maximum, it can extend beyond 36 months. There is a rider available at an additional charge to continue the benefits for an additional 36 months or the lifetime of the annuitant, whichever is selected and whichever is qualified for. So the base policy, you get benefits for 36 months, and for the rider, it would be an additional 36 months or the lifetime of the annuitant. So it extends the benefits even beyond what that long-term care account value is. There is an optional rider for inflation protection. It's 3% or 5%. And that's on a compounding basis. And the riders are all at an additional cost. The charge for long-term care benefits, there is no charge when it comes to the base benefits. So with the Genworth TLCA, there was a monthly charge for the long-term care benefits, which ate into the account value. That's not the case with the annuity care. With annuity care, the way that they give you the long-term care benefit is they give you basically a bonus in terms of interest rate. If you use the money for cash purposes, for anything other than long-term care, the current rate as of October 1st will be 2%. But if you use it for long-term care, it would be at a 3% rate. That's where they're giving you a benefit. They're not actually charging you. They're giving you a little bit of a bonus if you're using it for long-term care. And again, if we take money out of these policies, any of these policies for long-term care purposes, qualified expenses, we do so on a tax-free basis, and that's the huge sale here. It's not as much the interest rate, although the interest rate's not bad. It's being able to take the money out of the policy to pay for qualified long-term care on a tax-free basis. With the annuity care product from State Life, the long-term care waiting period is only 7 days. So that's definitely an advantage with annuity care. And as I said, as of October 1st, the current rate's going to be 2%. That's guaranteed for 1 year. The long-term care rate is 3%. That's going to be guaranteed for 5 years. And the overall guarantee in the policy is 1.5%. But if you do have a client that you can get to right away, what you can do is lock in a 3% guarantee for the life of the contract. So instead of 1.5%, you can lock in 3%. The current cash rate right now for the next 3 days is 3.55%. And the current cash rate is 3%. That's guaranteed for a year. In fact, it's guaranteed for the life of the contract if you can do it right now. And on the long-term care rate, it would be 3.55% today and for the next 3 days. That's on cash transactions. If it's a 1035 exchange, you can lock in those same current rates. However, the minimum guaranteed rate over the life of the contract would be still 1.5%. But there's still an advantage to doing a 1035 now. You can't get higher current rates, but they're going to give you the lower guaranteed rate for the life of the contract. Let's see how the annuity care works. So this is just a basic illustration for them, also on a 50-year-old. And you can see, again, we were talking about a 3% long-term care rate and a 2% rate on the cash value side. And you can see correspondingly after 1 year, there's $103,000 available for the long-term care, and there's $102,000 on the cash value fund for use other than long-term care. So again, there's no charges, there's no hit to the account value because of long-term care. On the left-hand side, I just typed in what the benefit would be. I mentioned previously, whatever year you need long-term care benefits, they take the account value at that time, multiply it by 2.9%, and that would be payable over a 36-month period. So in year 10, if you needed long-term care, the monthly benefit would be $37.83. If you needed it in the 20th year, it would be $5,085. It's just based upon the long-term care fund value at that particular time. Let's go ahead and compare this to the Genworth policy. Let's take a look at year 10. And again, in year 10, we have $121,899 in the cash fund. We have a benefit of $37.83, so $122,000, let's call it, and just under $3,800 monthly benefit. If we go look at the Genworth policy, same 10th year, you can see that we have $129,000 available in the account value. So there's significantly more cash in the Genworth policy, even though there are being charges for long-term care. There's still more cash in Genworth policy when we're looking at this from a 50-year-old's perspective. And the benefit is $41.66 at that time. So not only is there more cash in the 10th year, there's also more long-term care benefit available. But if we look at the 20th year, we have $148,595 of cash. I'll go back quickly. That is less than the account value in the Genworth TLCA. The account value there is $172,000. However, we do get more long-term care benefit at that point. We've got $41.66 available in the Genworth policy. That's going to be, with these assumptions that I use, consistent over the life of the policy. But in the 20th year with the annuity care product, we actually have $5,085 of monthly benefit available. So one advantage of the State Life product is that we're having an increasing long-term care benefit because it's based upon an increasing account value, that being the long-term care fund. And so the likelihood is that this particular person would not need benefits when they're 55 or 60 years of age. Usually they would need long-term care benefits at age 70 or 75 or 80, and there would actually be more long-term care benefits available with the State Life policy. Less cash value, more long-term care benefits. So there's some trade-offs here. Let's take a look quickly at age 70 here. Again, this is on the state life side. So again, the values are going to be the same. There's no underwriting, so the account values for a 50-year-old will be identical to the account values for a 70-year-old. There's no underwriting. You could probably imagine that that may play an important role in determining what product to go with, the annuity care product or the Genworth product. There's really no underwriting when it comes to the state life product in terms of monthly charges. There is underwriting, of course, to qualify for the product, but not in terms of charges to the policy. So an 80-year-old is not going to be, let's call it, penalized because they're 80 and might not be in perfect health with the state life policy like they would with the TLCA. We can look at a couple of the account values. We can look at year 10. We've got $121,000, $122,000 of cash in this policy and a benefit of $37.83 for long-term care. If we look at it for a 70-year-old for the TLCA product, you can see that we actually have $115,000. So whereas with a 50-year-old, we had more cash value with the Genworth product, with an 80-year-old, we have less cash value with the Genworth product than we do with the state life annuity care product. However, the Genworth product does pay a higher monthly long-term care benefit in the 10th year. It's $41.66.67. Whereas with the state life product, it was $37.83 in the 10th year. I know some of the math can get a little bit confusing here, but we'll send you this out if you'd like. What's important is that in the 14th year, there is a crossover. So the monthly long-term care benefit with annuity care actually exceeds the monthly benefit available with the Genworth product in the 14th year, and there's more cash value available in the policy if they use it for purposes other than long-term care. So there's, again, a crossover. At some point, the Genworth product is better than the annuity care product and vice versa. So you really just have to sit down and compare the two for your client, and both serve a good purpose. They're slightly different. The conclusions that I came to was that at age 50, the Genworth product has more cash value than the annuity care, and it has long-term care benefits that are higher. However, the annuity care product might have more long-term care benefits at an age when the person is likely to be receiving long-term care. So if they're looking to really max out long-term care benefits, they may want to consider the annuity care option, even though it would be less accumulation value on the account side. But it's whatever is more important to them. If they really want to have the growth in the account value, then the TLCA product is going to be best for them. If they want more growth on the long-term care benefits, then perhaps they would consider the state life annuity care product. And that's for a 50-year-old. For a 70-year-old, it's a little bit different. The annuity care product actually has more cash value than the Genworth product. And again, that's because the Genworth product has the monthly long-term care charges placed against the account value. The Genworth product does have long-term care benefits higher than the annuity care. And as I just showed you, it was for the first 14 years. So again, there's some trade-off. If you have an older person that really wants to get account value growth, then the annuity care might be best for them. If they're concerned more so with the long-term care benefit, then it's kind of a trade-off. If they think that they won't need it until they're much older, then maybe the annuity care is best for them. If they think it would be at a younger age, younger meaning 80, 81, 82, then perhaps the Genworth product will be better. And we could do comparisons of these for whatever clients you have.